Today, we're joined by Jason Paltrowitz, Executive Director of OTC Markets Group, the operator of OTC QX, OTC QB, and the Pink Markets, where thousands of US and global securities are traded on a daily basis. Under Jason's leadership, OTC Markets has become a key access point for international companies looking to connect with US investors without the cost and complexities of a full US listing. Jason, welcome to Vox Markets.
Thank you for having me, Martin. It's a pleasure.
Great to see you. So let's start with the US investor side, shall we? We've seen a noticeable uptick in US trading of European stocks on the OTC markets recently. So what's changed in investors' behavior over the last couple of years?
Well, I think there's been two key things that have driven it. First, we'll do the pre-Liberation Day part of this, which quite honestly was US investors looking at Europe and seeing a sizable discount to their US peers. And I think we've run up in the US what really has been kind of a very concentrated market where, the top 10 stocks in the S&P make up 40% of the return. And so I think US investors were looking outside of the US to other markets that were maybe trading at a significant discount. The UK certainly at that time was trading at about a 40% discount, but it wasn't common to just the UK, it was throughout Europe. And so investors were slowly moving into those stocks, looking to get some upside there. Then kind of fast forward to Liberation Day and all the things that have ensued since. And I think that's kind of expedited that movement of US investors saying, not only is there what was there, right, a group of stocks that were trading at a discount, but now they're actually seeing legitimate upside opportunity given what's going on in the geopolitical landscape. And whether that's, European banks or European aerospace and defense, real opportunities for returns that are probably outsizing what could conceivably be the tail end of the US S&P 500.
So when you're looking at some of these European companies then, and the ones that are in particular drawing the most interest, are there any particular sectors or sort of stories, what's the sexy sector that these sort of US investors are most interested in?
What's funny is it's not so sexy. You're really looking at US investors going back to some traditional fundamentals. So certainly there's been a lot of news about European defense and aerospace. That's clearly a sector that's garnered a lot of interest from US investors. But outside of that, certainly we've seen financials really looking positive growth in some of the big global European financials. Resources around the world have taken a rebound. So not just in Europe, but if you look at resource companies in Australia and Canada, really seeing tremendous upside. And then some of the traditional, like I said, boring securities, right? You see it in pharmaceuticals, you see it in consumer durables, you see it in, stocks like European supermarket chains. That are really just taking the advantage of A, having traded at a discount for so long, but B, US investors looking at kind of a post New World Order, if you will, of how those securities are going to perform in their new markets.
Well, as they say, boring is good, eh, Jason?
Yes, sometimes it is.
Well, you also seen a number of large, quite familiar sort of names from Europe and the UK in particular start to cross trade on your platform. I'm interested to find out what's really driving that momentum. And I'm particularly interested, is this US demand or are European companies taking more of an active approach to broadening their reach?
I think this is really a case of chicken and egg, right? What comes first? Certainly, European issuers were seeing a dramatic shift in US investor interest. And so all through last year where we saw a significant increase in some of the largest global players joining our market, whether that be the London Stock Exchange or Reckitt Benckiser or Compass or Aviva, and many others, those companies were seeing that there was an opportunity to take advantage of that interest from US investors. They also realized that the way our markets are structured, the way US markets are structured, they had a choice, right? As you pointed out at the beginning, there was either the cost and complexity and risk of being a fully fledged US exchange, or was there an opportunity through our markets to access those investors in a way where they were meeting corporate governance standards, where they were compliant with US state securities laws? And that's what our QX market in this case provides. And so it's how do we access those investors in a way that's efficient, which has less risk, which complies with all of the US regulatory ecosystem. And I think those two things married well for us and saw tremendous growth. And those companies are continuing to hope to take advantage of that opportunity going forward.
So can you just give us a quick breakdown of what is the difference between the QX and the QB?
Really, it comes down to our QB market is a venture market, growth market. So it's where you'll find, from a UK perspective, a lot of AIM or Aquis listed companies, right? Companies that tend to be, although not always, pre-revenue, early growth. Our QX market is for well-established global brands, if you will. The key differentiator there is that no company on the OTC QX can be what's considered a penny stock in the US regulatory definition of a penny stock. And so from an investor perspective, when they're looking at QX for QB, they know that the securities on our QX market, full stop, not penny stocks, in again, that SEC definition of a penny stock. Whereas on QB, these are opportunities in pre-revenue growth, where traditionally US investors tend to be much more apt to invest in those types of securities, but it definitely differentiates based on the size of the company there.
So the big names that have come and joined you, like the Avivas and the Tescos, and God bless them, even the London Stock Exchange Group have joined. They're on the QX.
Correct.
And have you? They've all come on that board. And have you seen any noticeable trends in how sort of US investors are trading these stocks?
So we have, and I certainly can provide you the data there. You see a noticeable uptick in not just the U.S. trading volume, so the volume that crosses our market as U.S. investors now have, again, a security that they can invest in that meets all of the state and federal securities regulations, so a compliant security in the U.S. But the way our market is structured, unlike the New York Stock Exchange and NASDAQ, is we're a secondary market. We're not a primary market. So while we see tremendous increase in the US trading volume that prints here, what you also tend to see is a large increase in the trading volume that prints in the home market. And so again, think about it like this. These Tesco, if you will, as an example, they're not placing new securities in the US. Their securities all sit in the UK. What we're providing with QX is primarily an advertising board and a bridge where US investors can trade with their US brokers in US dollars during US trading hours on a US ticker symbol that sits within the US trading ecosystem. But in order to facilitate that trade, in order to get the securities for those investors, a lot of that has to be executed in London. And so global exchanges like to work with us because rather than be a liquidity sucker, if you will, we're a liquidity provider to the home markets, helping those companies. So you see that trading volume increase both in the home market as well as new opportunities for trades that print here in the US.
So it sounds like even for London listed companies, then, it's really important having that US trading presence, during US market hours, even if the primary listing and the liquidity is still in the UK, there's an advantage to being listed with you guys?
Absolutely. I think a lot of companies and even a lot of investors don't realize that once you get outside of the very large global institutional investors into your second and third tier, third and fourth tier institution, your family office, your retail, certainly. If you don't have a US ticker symbol trading in US dollars, it becomes very complicated to trade overseas. And don't think about it in a single stock because people will say to me, "Oh, well, if you want to buy Tesco, you can go to London and buy Tesco." But it's really not that. It's that you want to buy global equities. And outside of the large institutions, it becomes very costly and complicated to have an account in London, to have an account in Switzerland, to have an account or to be trading in pounds and in euros and in Swiss francs and in Asian currencies. And so what we provide is that ability to trade those securities in a US dollar denominated security here in the US with their broker of choice. And so it is important. And again, not only is it just that long tail of institutional and retail, but even the largest institutions in the world where they're putting on large block trades, what in essence we're doing is just expanding the trading day. So even part of those large institutional trades, when Europe is closed, those orders can be filled here in the US, where we're still pricing the security in US time zone.
Okay. So, you know, a lot of people would ask, well, you know, OTC Markets, is that a competing venue with the London Stock Exchange? But it sounds to me like it's more of a complementary thing. Would that be right? And if so, then how do you see sort of cross trading fitting into the broader market ecosystem?
So we are absolutely a complement, and in fact, we have a saying or a marketing slogan, right? List local, trade global. And the press in the last couple of years has made a lot out of companies that are taking the decision, should we list in the United States or should we list in our home market, London, Paris, Frankfurt? Again, our list local, trade global approach is basically that you should list in your home country. You should remain a patriot, fly the flag, be a national champion, support the ecosystem that nurtured you, and stay there. But ultimately, with the recognition that the U.S. investor community is large, diverse, vast, help support valuation, help support volume, help support a whole host of things in the secondary market. And so we are that complement to global exchanges around the world where we can go in and say, look, don't think about is it New York or your home market. You can have New York and your home market in a way that supports your local capital market infrastructure in a way that's much more costly, efficient, less risky, but you can still have the secondary market benefits of the US investor base. And so that is a message that continues to resonate. Certainly, we've been helped by the trends that you mentioned, right? US investors now taking a new interest in European and Asian equities. And I think that trend will continue as I think we're seeing a shift that is not a point in time, but is going to be structural change long term, in that US investors, I think, when I started in my career way back, the investor outlook was that you should be diversified and maybe 5, 10, 15% of your portfolio should be in non-US equities. I think that's shifting to 30, 35, 40%, and we're going to continue to see that shift. And so to meet that demand of US investors diversifying globally, I think issuers are going to continue to look to OTC markets as the efficient way to do that cross trading.
Well, it certainly sounds like the investors there are looking at a global portfolio now as opposed to a domestic one. So, yeah, it's very, very interesting. Well, Jason, that's certainly a fascinating look at how global access and sort of, I suppose, investor behaviors are reshaping cross-border trading. So, thank you so much for your time and, of course, your insights today. I always enjoyed speaking to you.
Thank you, Martin. It's always a pleasure.